Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures is moving as would be expected as we head into first notice date in a couple days. We had resistance overhead at the 348 mark last week, and after the market came into this area, the market has since dropped. We're looking for a downside potential level coming in at about 335 to 338. And as we can see on the chart, the market did come in and make a low very close to 335.5. The market is bouncing from this level at this point, but given that we have first notice date in a couple days, the markets are rolling over to forward contracts. We believe it's in the cards for corn to perhaps make a low sometime at the end of the month, and if that low does not hold at month's end, we're looking for it to make a potential low in the middle of December. That carryover movement would be seen by way of the March or other forward contracts, but for here we do anticipate a potential low coming in somewhere at the end of this month or in the middle of December. The low that was made yesterday and today is consistent with the 45-degree mark underneath at 335.25, and overhead resistance was just beyond the 360-degree mark at 344.5. We anticipate that the market could very well trade inside of this range for the next 2 weeks as the market moves to come off the board. The March contract appears to have made a low right on top of our March 28 time factor dotted line as we can see on the chart. And the low that the market made today and yesterday as well as the previous low are right on top of support. Overhead resistance was just shy of the 360 mark at 358. Downside support was near the 348 mark. We anticipate that the market has a very good chance of staying inside of this range for the next week or two. And upon breaking either side of these ranges, we think we could see some continued follow through in that direction. This contract right now is caught up in the midst of volatility-based support. Additionally, we have the 360-degree mark below at 347.5 and anticipate that the market should find trouble trying to get below this number. In the event that it is able to break below 347.5, we think that the next target objective would be in the range of 340 or so, at which point either of these levels we believe to be where a significant low should be made and from which the market has a good probability of making an advance. Despite record-breaking crop projections, the soybean complex has been able to hold its own after making a significant low back in August. The advance from the August low up through the October high gave us a 5-wave sequence where the market came in and gave us wave 1, then wave 2, wave 3, wave 4, and then finally wave 5. Since then, we've seen a 3-leg correction, or an ABC, from that move, and what we also have identified is that this pullback happens to be 50% of the retracement from the August low through the October high. That being the case, we believe right now that this contract sits at a critical threshold. If it's able to break above the $10 mark prior to breaking down below 984, we believe that the market stands to rise higher somewhere in the neighborhood of 1023 with the possibility of reaching 1032. In the event that it breaks below the 984 mark prior to breaking above that $10 mark, we think a retest of previous low is probable and perhaps even lower. Over the next week or two, we're going to be particularly watching those two levels to see the way in which this market's able to trade. For now, it seems to be trading a bit sideways after having made a nice advance about 2 weeks ago. So again, those two levels continue to be very important for us. It does bear noting that volatility-based support below does rest between 953.5 and 965. So in the event of a breakdown, getting below this area should prove difficult for this contract. The December week contract appears to have found some very good support near the 405 number that we've talked about as a potential target objective for this particular contract. You can see that 2 standard deviations below the point of control is that 405 number. The market came in, made a significant low after having touched right up against our 1-by-1 upside angle, and from here the market is now making a nice move up just ahead of our November 30th timeline. In doing so, we believe that the market now could find its way a little bit higher, especially since we are trading in accordance with the divergence that we had spoke about before. In the event that this market's able to hold above this 417 mark and preferably above the 424 mark, we believe that the market could very well continue its way higher over the next 2 weeks before coming off the board. Additionally, this December contract is just recently having bounced off of volatility-based support and posted an N-band extreme indication. This reversal now starts to move its way above the 360-degree mark, which is a very significant point of control for markets in general when markets get to thresholds that are multiples of the 180-degree mark for trading. From here, in the event that this contract could get some legs, we would look for near-term resistance overhead near 428.25, and above there, the market then would look to perhaps test closer to our volatility bands that are downward sloping right now, and perhaps get to about 440 prior to coming off the board. Moving that much in a short amount of time is improbable, given that there is only 2 weeks left and that this market is in fact coming off the board pretty soon. So instead, what we would be looking for a realistic target objective would be something in the neighborhood of 428 to 430. The March contract is where we first highlighted the divergence for you, and you can see in this market here, as it's been making subsequent lower lows, the strength and the momentum of the move has been shrinking significantly. The market has now come into our timeline, and in doing so for a potential bounce at month end as anticipated, again looking at the bounce right above the 360-degree mark, we could very well be in the midst of the low having been posted for the March contract, and some overhead resistance then that we would be looking for is either at 445, and longer term, if this market is able to get some reasonable legs, a minimum price objective at 466.25. These are potentially some important levels for this contract moving forward. Over the next 2 weeks, it's going to be important to see the way in which it travels through these key levels. Like its December counterpart, this March contract also posted an N-band extreme against our volatility-based bands. And our next timeline that we're looking at is about December 4th or 5th, since the second falls on the weekend. December 5th also seems to be important for this contract because of the region upon which it's getting ready to enter. And when markets enter some of these predetermined regions that we've established on our charts, we sometimes do notice a bit of a change in trend that does occur. In closing, we'll take a look at the US dollar. And as we can see, after the market went up to our resistance level at $95, it was not able to get beyond this area. Additionally, this area did coincide with volatility-based resistance overhead. Upon reaching this threshold, we now see a very dramatic down drop all the way down to our 270-degree mark at 92.91, and the low that it made did post a key extreme right at the volatility-based support levels. We would also like to point out the way in which this market, after having hit this threshold of resistance at 95, also coincided with our timing factor for this circular arc. Upon hitting this arc, you can see now that the market has actually been tracing this area very well. And once it gets to about the 3 o'clock point of the actual circular arc, the markets can often bounce off of these levels, as the market will find it very difficult outside of a very escalated big fast drop to downside to continue to trace along these arcs. These arcs that we use for these markets, when scaled appropriately, enable us to find areas where the market can potentially jump off, and it also enables us to find where the market may trade as far as trend is concerned. Now that this market is moving away from this arc, we would need to establish a new one, but for now it appears that at least for the short term that the dollar may find a bit of support and perhaps move its way back up again, or may find a bit of support before potentially turning back down and tracing out our larger term weekly chart projections. Taking a look at our longer term chart, we can see that our wave A or 1 came in and made a nice low. Since then, the market did make an advance to our proposed potential wave B or leg 2. The market made a top at that $95 mark that we discussed previously, and from there the market has made its way down a bit over the last 3 to 4 weeks. Right now, we're finding some potential near-term support near the 92.5 number, and the market could very well continue lower, and if it does so, we would be looking at a target objective, something in the neighborhood of $90. We'll continue to monitor the way in which it trades from here, but if the market does find some legs and instead decide to turn back up, we do think resistance overhead in the neighborhood of 95 to 96 is probable. at which point the market could then turn back down, causing our wave B to be shifted to the next leg before the market's able to make its way back down to a proposed wave 3 or C. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.